Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell for Thursday, November 3rd, 7:19 as I'm starting the video. And as always, please run that player at 1.5x. What I'm going to do this morning is skip the pre-market read, the macro stuff, and earnings. I want a lot of chart work after yesterday's big reversal that I want to go through, so I want to devote that time to the charts on multiple time frames to kind of give you an idea where we're at. But suffice it to say, we are down this morning across the board in the pre-market follow-on selling to yesterday. So let's dive right into the deck. U.S. dollar, wide-ranging bar yesterday, but you'll notice we're at 11.23 on the index, above our trend line, and key support here at 111. And I guess what I want to say, I'm not a huge student of the Fed, but let's just recap what happened. The market had largely priced in 75 basis points. We got that. That was all in the release. Pretty much what everybody expected. And then you got the move higher on that because it, kind of met expectations. And then when the pressure started, what Powell basically did was gave no opportunity or no thought or consideration to backing off the rate hiking cycle, even though the pace of the increases may slow on a meeting by meeting basis. So what I mean by that, so 75 was priced in for this time, and more or less 50 basis points priced in for the December meeting that comes up in roughly a month to 6 weeks, right in that mid-December time frame. But what the market was expecting was some commentary along the lines of, at the December meeting, we see things moderating, and we may, pause at that point, take a look, we want to become more data dependent, blah, 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 blah. We didn't get any of that. In fact, he went the other way, saying, we see no reason at this point in the data to slow down or pause. So the market took that as meaning they're just going to keep going. So what does that mean for markets? Well, it means, I would imagine, resumed strength in the dollar, right? Rising rate environment, strong for the dollar. And then when we go to TLT, rising rates means falling TLT, and taken together, that means falling liquidity. The pool is still draining. Remember, we talked about back in the late spring and early summer that the market pool of liquidity, monies available to the market, was, overflowing the top of the pool, to use the metaphor, and that the process of rising rates and QT, quantitative tightening, reducing the Fed balance sheet, is like pulling the drain plug at the bottom of the pool to lower that overall market liquidity, tightening monetary conditions so that that would be a headwind for markets. So now, 6 months later, 7 months later, however long, the market was thinking that, okay, we've taken the majority of the pain, that, we've knocked down inflation to a certain degree, but from Powell's perspective, not nearly enough. So that was the reversal in the commentary. And in these times where the Fed is so central to the whole thing, it should be a reminder that when you've got these macro events, when you've got these Fed meetings, the release is one thing, but the commentary, excuse me, the commentary is everything. And what you saw here was, a dovish release, but with a hawkish pivot on the commentary. And then that, of course, rules the day. So back to our TLT. Breakdown, back test, rejected. So unless TLT can get above 98, I see this going down. And I think if you're wanting to trade this, I think you've got a very objective short against like 97.5, 98, and then looking for a move lower. Whether we go back down to revalidate this low at 92 remains to be seen. But from a technical perspective, that's what I would expect. A breakdown, a back test, come back down to 92, where you've got that opportunity for a double bottom low with potential divergence. Here's the one half of the W pattern that we look for on a double bottom setup. We've got the left side of the W, the left side of the middle part, and then kind of looking ahead, come back down for a revalidation of that low, then bounce up. And that'll take, multiple weeks to play out. All I'm saying is you got a really nice line here against the 20, the downtrend line, and lateral resistance at 97.5, 98 to shoot against. VIX really didn't react yesterday, but now I think the key pivot here on the VIX is 25, and I would expect that to hold. And if more selling ensues, that this would bounce. Now, if things start looking better, and you get a VIX break below 25, then I think you got something cooking to the upside. Something different were to happen. Now, don't forget we got the October jobs report on Friday. I'm sure Powell already knows what that is, but what he doesn't know is the election results. And if there's a regime change, you may see a sharp upside move. I have no idea what the market may think of a regime change. All I'm telling you is that's a potential big macro event on Tuesday going into Wednesday, Thursday, and there's going to be a lot of races, I assume, that are going to drag their feet on counting, mail-in ballots and all that kind of stuff. And there's going to be a lot of tight races that you won't know for a few days. But all I'm saying is be aware of the election as a potential catalyst for at least a short-term upside move. Bitcoin held in there pretty well. Oil had a good day, but it's down again this morning. I think 88 remains your pivot. There again, lot of forces at work in oil. I mean, it is holding its own, but not really going anywhere. You've got the conflict of, or the prospect of, a hard landing if Powell keeps going, and a recession would, definitely nail demand. But you've also got a very tight supply situation. ConocoPhillips just reported this morning, blowout earnings. The refining margins, we talked about diesel fuel, 25-day supply. Those refining margins will stay strong. And you got a very tight overall supply situation in oil. So a lot of moving pieces in oil. It's not a situation where a lot of people, if you look at the commodity reports, not a lot of people are long, and not really any people are trying to short here. They're kind of waiting for more information. So I still like, I still think energy complex is going to outperform, but remember, outperforming doesn't necessarily mean going up. If the energy complex is down 0.5% while tech is being destroyed, that's outperforming on a relative basis. But unless you're just like a buy and hold guy, if you're trying to actively trade it, don't confuse outperformance with actually going up. So we're going to have to watch that really, really closely. Gold did not like the higher interest rate, so that we had a nice head and shoulders here on the gold miners. That has obviously failed. So no trigger, no trade, never actuated the setup. So I'm not really interested in trying to, short gold or actively trade it. But I was looking for a long there. That would have been a really nice kind of move, but it didn't happen. Moving on to our oscillators, proving once again, it's never wrong. It's never different this time. Overbought, reversal, down. My base case, and you see it in the charts. Once you go overbought, the tendency is now you got to get oversold, and so you see it here: break down, break down, break. We'll have to see if it goes down, but you can just see how this thing behaves, and you get those directional changes, and it tends to want to find the bottom before it goes down and then comes right back up again. So I mean, those oscillators, I tell you, man, really, really powerful. And we saw the same thing on the NASDAQ. Overbought, down to oversold, tag of overbought, down to oversold. Here was a situation where it got halfway and reversed, but here again, oversold to overbought, and now or at least the behavior of the NASDAQ oscillator would tend to have me leaning bearish on that. Let's dive into the charts. We got rejected right along the top here at 390. Now we're back down, heading the other way. Remember, this was a more or less a 50% fib retracement, and now we're coming back down looking for our lower pivots to trade against. And remember, I put today's pivot right at 375, but remember, our big pivot was at 370. So, a break below 370 would open up the door down to, remember the June lows were 362.50 down here, and then we had other lows at more or less 356 and 350 to look at on the downside. Moving down to the 60-minute chart, really interesting. One of the things in your little trading black book, as it were, the first move out of the Fed is usually fake. Nothing is 100% of the time, but again, it worked this time. And if you were Johnny on the spot yesterday and you saw this, this is the first bar, this big bar here is the announcement, the announcement bar, the release at 2 o'clock. And it rocketed up right into this line of resistance and then backed away. And then on the way back down, you lost a 50 EMA. And that, even if you didn't catch this, even if you didn't say, okay, I'm at resistance, very objective place to short against the high over here. So if you were willing to give $1 or $2 of risk, you got a perfect entry. But, even if you didn't, what are the trading rules? You lose a level from above, that's a short. You lost a 50 EMA here in the 381 area. You saw this line of support here that broke. If you got short there, that still turned out to be an excellent trade. You got $5 out of it in the last hour or so of trading, and this reversal was on his presser, of course, and then it was just gangbusters to the downside. So today, I know I just said on the daily chart 375 pivot, but you can see on the 60-minute chart getting some resolution. I've really got that at 374. You've got two high volume bars here, and you see this little line across the level here. Support, resistance, support. And so now a break of 374 would open up the door to that bigger pivot at 370. And then below that, you've got a gap down here at 364 to be aware of that has yet to fill. On QQQ, never was able to take out the 50. We had rejections across the top here at 285. Just like SPY, there was a reach up to resistance that was rejected, and now we're down into this gap here below that has yet to fill. And we're below that big pivot we had been talking about, 380, 380 on SPY, 270, 370 on SPY, 270 on the Qs, and 170 on IWM. We'll get to that in a minute. But now we're in here with the gap, and my expectation would be for this to fill down to this low here around 261. If we move on to the 1 hour chart, you see the resolution on that. I don't know why it didn't move my things here. Sorry about that. But you've got a pivot point here at the top of the gap, and then you've got the big pivot at 270 on the upside, and unless and until price can regain that 270 pivot, then I think you gotta lean to the downside, especially being in this gap. This 262 was a big line of lows. Remember, we had that bad opening a few weeks ago where it reversed, but now we got this gap to fill down to 260. And if 260 were to break, I would be looking for 255 down here to revalidate this low down here. Moving on to IWM. Interesting. Rejected right at the convergence of the 200 EMA in gold and the 200 SMA in black. Never could get into the gap. Came down here, lost this 182.5 level, and then it was gangbusters. So now we've got a pivot here at 176. And if you break 176, take note that you would be below all the moving averages. You got the 50 coming in right here, and you got the 20 coming in right here at more or less 176. So if you were to break below 176, that held, then you'd be back below all the moving averages, and of course, that's never good if you're trying to be bullish. I would definitely lean bearish on that move. And then you got support levels all the way down. Now, IWM has been outperforming. Why? Real world economy type stuff. The economy's been doing pretty good. Probably less sensitive to interest rates than, say, tech. So it had been outperforming, but that doesn't mean going up. That means going down less. You've got the big pivot here at 170. Remember, that was a level that we had talked about way back when. But also remember this 176, resistance, support, big line of resistance here. So that 176 is a big one, and breaking that to the downside would open up 173 and then 170, and we can see it real well on the 60-minute chart. Notice here again that phenomenon that we just talked about on the Qs and on SPY. The initial fake move right up to resistance, right up to the bottom of the gap. I mean, if you got that, you were absolutely golden. Second chance was moving back into this prior trading range at 182. You had also a shorting chance at the midpoint at 180.50. And then a chance at 179 once it broke this support level from this trading range. Now we're in no man's land. Next support at 176. And that's really, really important, that level, because remember, this was a $12 wide trading range. We can break that up into two parts. A upper half, $6 wide, and then a lower half, $6 wide. And so at 176, a break there opens up a path to the midpoint, 173, and then down to the big pivot at 170. And then there's a $3 gap to fill, and then to the bottom of the box. So big picture, you break back into a $12 trading range. What do we always say? You don't want to see that if you're a bull. That would make all this look like a fake move. That would make all these people realize that they were wrong buying this breakout, and that supplies some of the fuel for additional selling to the downside. So 176 becomes really, really important in the days and weeks ahead. Meta, we had our initial bracket trade on this massive gap down. We broke the low side of the bracket the other day, and we have yet to reclaim it. And now we're down here at 90, which we've been saying is that massive 7-year monthly support. If things fall apart from here, you've got a really nice long-term pivot at 90 to factor in to your trading. And if you're trying to actively trade that, you can go back to the daily chart. But just remember that big monthly support is sitting there at 90. And remember, that goes all the way back to 2015. So I mean, that is 7 years of gains have been more or less wiped out this year. So that's significant. Apple, reach up candle, came down. If you had the gap marked, that move into the gap was definitely a short. So now we're back down here to 145 at the bottom of the gap. The gap's been filled. You get a break below, I think it's 142.50, and then there's a lower gap down here, more or less 140 and a half, that has yet to be filled. That would take you down into the 138 range, which were these lows. And then you've got that spike low down here at 135. So I think anything below 145 is going to open up a lot of downside. And remember, or notice that you've got a high volume over price bar here, that once it breaks below, then that's going to be a lot of resistance on the way back up, simply because you can see a line of rejections here, a line of rejections here. So break below, even if you come back to 145, 145 and a half, that's going to be stiff resistance on the chart. So I think that's, I don't know where it's going to open today, but just keep that level in mind. I want to show you the daily chart. You can see that 144 is a big level. Once you break that, then these other levels come into play that we just discussed. Moving on to Tesla, we had come up, recaptured that 222, and it had been toggling, but then yesterday we lost that 222, 220 line, dropped down to 215. I think that's the pivot for today. Below that, I think is that 207.50 range, and then you've got the prior lows down at 200 that in my mind would be targeted. Moving on to Microsoft, we had this 235 pivot dead to rights, right? We had a whole big line of support, got a rejection here, but then we recaptured it, big line of support, lost it, came back to revalidate it, and then has fallen away down here to 220. If you shorted it back here and were willing to take that FOMC risk, then you were golden there. But even just yesterday, losing this 227.5 was a sell, And then, of course, losing this line here at 225 was a sell as well. So that brings us down to 220. I want to jump over to the daily chart. This 215 level has been brought over from the weekly chart. I think that's going to be a key level. We can look at it here on the weekly. You can see that we're coming down into this 618 retracement level here. I mean, you've got a high volume over, double high volume over price bars here at around 215. You lose that, then my expectation would be a run down to towards 200. Amazon. Going to show you the weekly chart here. It's in, I mean, really, really rough shape. We're back down into a weekly trading range that goes way back into the 2018 time frame. We lost this 102.50, and that was, and we have talked about that earlier in the week and into last week even. We had all this support here. You can see how many weeks we came back down respecting this big trading level that had happened years in the past. And once we got below that 102.50, then that became resistance. And you can see that, you know, it has since fallen away. And now we're back in this trading range. And, you know, we do have a high volume over price bar here that comes in around 87.50 as support. But the expectation is, you know, once you come back into that trading range, the target becomes the bottom of the range down here at 77.50. So a lot of work ahead. And now you've got a line to recapture at 96, and then 102.50 on the upside. If it can recapture that, then, you know, it'll get back on, I won't say the right side of the chart, but disaster will have been averted if we can get once you get a weekly close above 102.50. Then that will again become support. Google has really fallen away as well. We had remember what we were just talking about the other day. Was 96.5 going to be? Well, we knew it was resistance. But what we were saying was, is this going to be a breakdown backtest fail or a breakdown backtest and break out to form a bear trap? Well, obviously it was the former. A breakdown backtest fail and then big rug pull. You know, losing this prior low in your, you know, technical analysis 101 handbook. Whenever you break a prior low, that opens the door to further selling. Came back down here. This was the fake reach up candle back up to 92 where that failed, and then it just reversed and went down. I want to show you the daily chart. Broke that measured move that we had been talking about down here. And let me find the weekly chart to show you where we stand there. You can see we've lost this 618 retracement level that comes in right at 90. And now you can see actually there's a very faint line of support here in the 85 area, but then notice that the volume over price bars fall away, and you've really got an open door down towards 77.5. And remember, or notice, that was the pre-COVID high. And the pre-COVID highs have been a level that we've been talking about for months and months and months. And now it looks like the door is essentially open to go down and reach that level. Netflix, bad day at the office, like most stocks. We had this stellar gap up. We had our bracket trade, grinding out, $10 levels, break out of the bracket, got to the 200, broke the 200, got to 300, made several attempts above, dropped down below 300, back to the 200, and then one last try at 300, got rejected, broke 290, which opened the door to 280, break at 280, opens the door to 70, a break of 270 would open the door to 260 at the bottom of the bracket, and then if the top of this gap were to break at 260, 250, then I would assume the race would be on to fill this gap. There is some support here at 250. You can see a rejection here, a rejection here. That makes this 250 support. But, if the selling persists, you've certainly got objective levels at 270, 262.5, and then 250, and then a complete gap fill down to 240.86. Semis, fake move right up to the bottom of the gap. There was a rejection there the other day. Your fake move came right up to tag it. If you didn't catch that, you had a very objective sell at 190, and that was good for $5. Again, demonstrating the power of not only losing a level from above is a sell point, but we had a $5 trading range here, and once you broke 190, that opened the door to, although I didn't have it boxed in, there was a box there, dropped right down to a key pivot at 185. All this support, all this rejection makes 185 really important. You break 185, I think you're going to come down to 180 sooner rather than later. ARC complex, if tech's down, ARC's going to be down. Rejected right here. You lost to 50. Now my expectation is back down towards 15 on ARC F. If there's some type of reversal, anytime in the future, you've got the 50. You've got the more or less the midpoint of this box here at, I'm just going to call it 1675, 1680, something like that, where you've got a daily pivot. But, given how things are trading, I think it's going to come back down to 15. ARC G, same thing, same exact chart, really, from the standpoint of reaching the 50, getting rejected along the bottom of this box, 34.25. Now we're down below. So this looks like a breakdown and a back test. You do have support here at 31.50. Below that, then you've got the prior low at 30, and you got these big time lows back here at 27 if things really fall apart. ARC K, beautiful technical action, really. Rejected at the bottom of the box, came back up again to the bottom of the box where it got rejected at 40. Now you've got some support coming in at 36, which I think is your pivot for today. And then you've got 34 being these prior lows here across the bottom. And that would, if you lose 36, then I think you're going to be coming down to 34, I would say rather quickly. Come back down and flash these lows for a test, and then that'll be a big, big decision point. A lot of stuff here, guys. ARC W rejected along this line, rejected at the 50, little fake move, lost the 50, and then right back down to the bottom of the box at 46. I think 46 is your clear pivot going forward. Once it drops below the bottom of the box again, I think you're going to come back down and test these lows here at 42. So, a lot going on, but also a lot in front of us. The Fed has clearly told us they don't see any reason to back off. The liquidity is still draining. US dollar higher, TLT lower, bad for stocks. Probably going to be worse for tech than the other indexes, but they're all racing towards those key pivot levels that we've identified and that I went over this morning. I hope the analysis is helpful to you today. Hope you didn't get trapped in that fake move yesterday. And congratulations to those of you that either, recognize the fake move as being fake. That's number one. Don't get trapped in a fake move. But number two, once you saw those levels failing from above, that was your signal to the downside that things were starting to fall apart. So let's wrap it up there. This has been Chris Buss with Traders Profit Compass. Talk to you next time.